All right, let's jump right into it. The 2024 Bitcoin halving. It was supposed to be this huge crisis for miners, a massive stress test for the entire network. But instead, something completely unexpected happened that, well, it's basically rewritten the entire economic playbook for Bitcoin.
I mean, just look at the difference here. On one side, what everyone expected, a minor crisis, network instability, the works. But the reality? Whoa. We're talking minor profitability, security that's never been stronger, and a Bitcoin network that's just rock solid. So what on earth happened? That's what we're going to dig into.
Okay, so to really get how we got here, we've got to start with a problem that's literally baked right into Bitcoin's code. It's this recurring, it's like a pressure cooker event that happens every 4 years, and it's called the halving.
So what is the halving? Here's the deal. It's a pre-programmed event. Every 4 years, like clockwork, the reward that miners get for securing the network gets sliced in half. Now, this whole thing is designed to make Bitcoin scarce, right? Kind of like digital gold. But just imagine your paycheck getting cut in half overnight. That's the kind of massive economic shock we're talking about here.
And that brings us to what the old miner paycheck looked like. I'm serious. Just think about that for a second. Your salary getting cut in half every 4 years. How in the world are you supposed to survive? Well, that's the exact problem miners have always had to face.
And this chart, wow, it makes it crystal clear. Historically, a staggering 97% of a miner's income came from that block subsidy, the very reward that keeps getting chopped in half. And transaction fees? A measly 3%. It was barely even a rounding error, pretty much insignificant. And this right here, this highlights the real danger. When that main source of income gets slashed, the miners who aren't super efficient just can't afford to pay their massive electricity bills. So what do? They have to shut down. And when they shut down, the network's total computing power drops, and that means its security gets weaker. This has always been the big, scary what-if for Bitcoin.
But then, just when this old problem was about to rear its head again, two completely unexpected heroes showed up on the scene: Ordinals and Runes. And these weren't just some minor updates. No, they were absolute game changers. So first up, you've got Ordinals. Now in simple terms, this protocol basically lets people inscribe stuff. We're talking art, text, you name it, directly onto the Bitcoin blockchain itself. It's almost like digital graffiti. And this, all of a sudden, created a brand new reason for people to fight for space in every single block.
And right on the heels of that came the Runes protocol. This made it incredibly efficient to create new types of fungible tokens. You can think of them like custom digital currencies, all built on top of Bitcoin. So you put these two innovations together, and they just unleashed this tidal wave of new activity, with everyone competing for the exact same, very limited block space. And all this new competition, it led to a full-blown revolution in the fee market. It completely changed the game for how miners make a living. Seriously, with everybody and their brother trying to inscribe art or create new tokens, a fierce bidding war for that precious block space just erupted. Suddenly, that tiny little transaction fee wasn't so tiny anymore. People were willing to pay a serious premium just to get their transaction squeezed into the next block. And boom, here it is. This is the aha moment. The entire economic model has been flipped completely on its head. You see that shrinking block subsidy? It's now just 40% of what miners are making. The new king? Transaction fees, making up a massive 60% of their revenue. I mean, this changes everything. Okay, so miners are making more money. Great for them, right? But why should you or I care? Well, it's simple. Because profitable miners mean a stronger, more secure network for every single person who uses Bitcoin. It's all about the chain reaction. See, you start with sustained high fees. That leads to miners being way more profitable. And when they're profitable, they can invest in more powerful computers, which increases the network's total computing power, what we call the hash rate. And a higher hash rate makes the network exponentially more expensive and way, way harder to attack. It's a virtuous cycle. So, if you're an investor, here's the bottom line. That old fear, the one about the network becoming insecure as the block rewards slowly faded away, well, it looks like it's being solved right now. This new, vibrant fee market makes the whole mining sector more resilient, and that strengthens the entire investment thesis for Bitcoin as a truly secure store of value.
What all of this really points to is that Bitcoin is entering a completely new chapter. It's evolving,
It's becoming so much more than just the digital gold it was originally designed to be.
I mean, what we're actually seeing is an entire ecosystem popping up, all built on top of Bitcoin's rock-solid security. It's becoming a home for digital artifacts, a launchpad for new tokens, and all of this attracts a much broader base of users and developers. And having all these different drivers of demand, it just makes the whole network that much more robust and resilient.
So when you step back and look at the big picture, the halving, this thing that was always seen as a potential crisis waiting to happen, has been totally transformed by innovation into a source of real, enduring strength for the entire network.
It's just an incredible reminder of Bitcoin's ability to adapt and evolve. Its core economics just went through a fundamental shift right before our very eyes, and it really makes you wonder what's going to evolve next.